welcome to the Big Five. We are here in the city of Mumbai, right next to the ocean. It's an absolutely fantastic place to be, and we have a really great audience with us right here in Mumbai. And we also have with us some of the top financial minds in the country, and we're all here to try and get you the answer to that one question that you're probably asking yourself. Where should I invest my money right now? Where should I park it? I'm hearing all these reports about the Indian economy collapsing and the global economy collapsing and what's going to happen to the rupee and blah and blah. Diwali is coming. Diwali is a very good time to really think about making some investments. So should it just be gold or should it be equity? Or should I buy a house, or what do I do? Put it all under the mattress. So we've got experts in the field, and I can tell you these are the top experts. So you should listen to them, and they'll tell you what to do with your money. And we'll come back 1 year later and we'll see how we actually manage. Come back next Diwali. So it gives me great pleasure, and it's a privilege to have all of you with us. Ramdev Agarwal, Joint Managing Director, Motilal Oswal Financial Services, one of the top voices and the top thinkers in the Indian stock markets. What he doesn't know about the markets probably doesn't deserve to be mentioned. So it's great to have you with us. Niranjan Hiranandani, Managing Director of the Hiranandani Group, who can tell us whether real estate actually is still a good play or is it not. So you will be slightly biased, I guess, so we will discount that, but we'll ask you this. You are biased, right? Okay. Gold. Many people want to go into gold. So Chirag Mehta, Fund Manager Commodities at the Quantum Mutual Fund, and has been tracking gold very carefully. Still bullish, I hear. So we'll see whether gold is actually the place to be in or not. Professor Binu Paul is at the TIS School of Management and Labor Studies. It's great to have you with us. He doesn't have a high opinion of the stock market. Again, it's a privilege to have one of the top mutual fund managers in the country with us, Nimesh Shah, CEO and MD of the ICICI Prudential Mutual Funds. Many people say that retail investors should just go down the mutual fund route. So we'll ask you if you think that is the case, and if so, which mutual funds should they be going to. And just in case you didn't think we had enough real estate gunpowder, if you like, and getting another voice to talk about real estate and to push that, Abhinandan Lodha, Deputy Managing Director of the Lodha Group, again presumably slightly biased in favor of real estate.
And slightly more informed.
Okay, fantastic. So great to have you with us. And maybe somebody who can help us balance between the different views you're going to hear, Roongta, CEO of Apnapaisa.com. Thank you all so much for being with us. Why don't I get opening thoughts from all of you, and then we can proceed and look at each individual category in some detail. Ramdev, why don't you kick off?
If you are looking for a return from this Diwali to next Diwali, that's about a year. I don't think this is the asset class to look at for 1 year kind of investing. I'm not saying that markets cannot move, but typically if you're looking for equities, you should have a very patient money, which has to be 3 to 5 years kind of money. And if you are in a hurry to get the return, that's also not the right kind of characteristic for equities.
So if you have a longer time horizon, do you feel that equities are still good?
That's the only way to go, because I can tell you this country is very inflationary. The biggest enemy of inflation, the biggest enemy of investing is the inflation, because investing means getting more purchasing power by surrendering current purchasing power, and that you can do it only if you can hollow the inflation. And inflation here is about 8 to 9% compounded, and I'm not talking about 2-3 years. I'm talking about 30-35 years of recorded history of 8.5% kind of inflation. So how do you beat them? The only way you can do it is if you go to either equities, real estate, or some farmland or something like that. But by going to the fixed income and gold, you barely cover the inflation. So you have to have some portion in equity or equity-like assets.
Okay, fair enough. Equity or equity-like assets. I mean, a lot of Indians would feel that historically one of the best ways to cover the risks that Ramdev was talking about is actually to go into real estate, and I want to get both you and Mr. Lodha in on this. Having said that, there are others who will feel that yes, real estate has been great, but our price is now a bit overpriced. So what do you think?
I think if you're looking at the next 1 year, or you're looking at the next 3 years, or you're looking at the next 10 years, or you're looking at the rest of your lifetime, you better buy real estate today. You're not going to be able to afford it tomorrow. So if you don't buy it today, you had it next Diwali, because the costs are going up, and every conceivable input of cost in terms of real estate is going up. In the last year, we have not had 8 and 9%, we have had 15 to 20% inflation and that includes 7 to 8% government taxes have gone up.
Okay.
So it's not just going to go up, it's going to shoot up.
So if you want to get real estate, do it now before it's too late.
Before it's unaffordable.
It already is unaffordable.
It will be more unaffordable.
Okay, before I come to this, let me just get your thoughts on it. Real estate, is this really the time to get in or wait for a correction? Do you think a correction is coming at some point?
I think asset class which has a higher beta is able to save itself from volatility as a natural hedge for inflation, along with the imminent demand-supply mismatch in India, especially in urban areas like Mumbai. Definitely make real estate a very, very good bet, both in the long term and the short term.
Okay, Dinesh?
Looking at the interest rates, at the level at which they are today, the 10-year yield been at the level at which it is, debt mutual funds are a very good option today. And in my mind, if you are sticking strictly a 1-year view, I don't believe 1 year down the line interest rates will be as high as that. So people need to understand that if interest rates go down, then bond values goes up, and debt mutual funds much better return.
But in the near future, it's possible that you will actually have an interest rate hike. In the very near future, given that
I'm not sure, that's why when you said 1 year, but otherwise on the equity side, I believe the way the markets are positioned today, if you take away 15 stocks from the market is quite cheap. The foreigners are buying 10 to 15 stocks in the country, those 15 stocks are expensive. Rest of the market is available at a very, very fair valuation. So when the fear is maximum, if you invest equity at that point of time in value stocks, then value makes a lot of money over a period of time. People like Mr. Warren Buffett showed us that.
right now, because there's so much fear in the market, get into equity because you probably will be getting
If you have got 3 to 5 years perspective,
if you've got a long-term
if
perspective.
3 years minimum, if you have that perspective, equity and value investing is the way to go in this kind of markets.
Okay, Ramdev was saying that perhaps the biggest threat that we are facing right now is inflation. Now, historically, actually, the best hedge against inflation was supposed to be gold. Now, increasingly, people say that's not the case, and both real estate are better, equity is better, but gold and the story for gold, given the way that currencies are being debased, monetary debasement, people are printing paper money like there's no tomorrow, that's been the real reason for the gold bull market. Are those reasons still there?
Absolutely. Gold is still best store of value. We'll often find corrections, and in those corrections you will find depressed moods on asset markets, be it gold, equities or debt. So when it comes to gold, we've seen some correction in gold as of now, but the case for longer term gold rising because of the currency debasement story and inflation coming over. Inflation is just a result of monetary inflation that is happening over the world, be it US, Europe or Japan. The solution to each of the problems is found in debasing the currency, and when currency are debased at will, gold has to go because it is a monetary asset which has lasted and acted as a currency for thousands of years.
People say that the gold story, it's had a great run, but maybe it's over by now.
Absolutely not, because if you see Mr. Bernanke seems to have tested the waters recently, and everyone is hoping that it's going to be tapered this time, but we haven't seen it as yet. Because you had seen the impact of what happened to bond yields. It spiked from 160 to 260 to 3%, and now again back to 260 because taper is not there anymore. We have seen impact on the mortgage markets. So it's going to be extremely difficult to unwind what they have done. So I think we are in experimental central banking today, and I think there is no easy way out of it. So I think gold is still a good bet over the long term.
Okay, I'm going to discuss each of these asset classes in some detail, including the possibility of just putting it into cash. So Professor Paul, let me ask you, what do you think people should do? Just keep it in cash under the mattress, equity, real estate, what do you feel?
That's very interesting. But then who can really handle shares? That's a big question. You need a lot of knowledge. You have to keep on tracking. I think analysts would never excuse for lemon mistakes. Rather, they would say you should have a check. But then, out of 500 million workers in India, what percentage would have the capacity to analyze? So, I think it's a matter of segmentation. While some of these conclusions saying equity is having good prospects would be applicable to high net worth group, but what about medium net worth group who won't have time and patience to see this?
Put it into a mutual fund and let the experts manage it for them. So that's equity, but they don't have to track it. They can just give it to I mean, just give it to the
I can give an example. See the brochure of any mutual fund. They write beta value. Even a professor won't be able to interpret it. Let's talk about physics professors. Would they be able to interpret what is beta value?
But you don't, Nimesh, you necessarily need to know beta value to invest in mutual.
What we have done in the last 15 days, what we have done in the last 1 year, 3 years, 5 years is very clearly visible to everybody. So at any point of
I think
time,
that is very nice. The reason I'll tell you, ask just using simple regression they are measuring, which doesn't stand the test of robustness. Do you have any robustness? I doubt. I doubt veracity of your computing.
You're asking me?
No, I'm just making a statement.
Okay.
no sir, it is very objectively done by lots of people as to what is the return given over, and it is numbers.
Okay, but hang on. So you're saying no equity, don't do all of this. What should they do?
I'm not saying, I made a point. It's highly sensitive to wealth segment you are in. If you are in high net worth group, well, you have patience.
Actually, I would feel that if you're in the high net worth, you probably got enough money. It doesn't matter what you do with it. If you're not that well off and you're heading for retirement, that's when you need to really manage your money the most carefully.
My point to this is, if you want to beat inflation, you need to be in asset classes which can be able to beat inflation. That is why a common man can invest even 5,000 rupees with a mutual fund. That is why he has to be invested in equity. If he wants to be invested in equity and he does not have the expertise, he should leave it to the experts, where there are a lot of people who track us regularly, so they can use their services and reach us. That's all I'm saying.
But we have a horrific record of world history wherein things have gone wrong. What analysts have done.
Okay, so what would be, I'm just trying to ask you, your alternative is what? To just keep it in, see, because there's a problem, there's a real problem of saying I'm just going to keep the money in a savings bank account, or I'm going to put the money into an FD. And the problem is what Ramdev started by saying, that if you've got your money in a savings bank account, which is getting you 3% return year on year, actually the stock of your money is depreciating because of inflation. So by the time you reach retirement, you'll suddenly find you're broke. That's a real problem that a lot of people are going to face.
Inflation is post-tax. Your whatever fixed income you get is pre-tax. So post-tax effective return is far lower. So actually every day inflation is taking tax out of you while you're sitting. So it is a serious problem in terms of how do you protect. Maybe you go to real estate, you buy a farmland, whatever. See, there are three forms of equity equivalent assets. Equity itself, which is the pieces of businesses in terms of entrepreneurship of India. You can buy 100 Reliance, you can buy 100 Telco, 100 Tisco, whatever you like you can buy. So that's the opportunity to buy into the businesses of India. And then you have a real estate piece, one you can buy for first home, which has equity like kind of thing. Then you have farmlands. So it's not that you have to buy only into pure equities. And there can be levels of
Get something which is
Something,
inflation hedge. I mean,
yeah.
gold is actually also inflation hedge. But okay, to finish the early opening comments, and I want to dive into each of these in detail, what would you be recommending right now?
I would say three kinds of investors, right? You have a first kind of investor who just can't be bothered what his returns are, and let me tell you, there are a lot of investors like that, right? And then there are these investors who want exceptional returns from their investment, and you have third, the savvy kind. I think all these questions that we are answering are to this savvy kind of investors, real estate.
Actually, I'm not. The savvy kind of investor quite often knows what to do. They already have a sense of it. What should the first type do?
I'll tell you. I think the other two investors, the guys who are expecting exceptional returns, are bound to be disappointed. Because there is no economic instrument that will give you high returns at low risk. That does not exist. Clearly, that defies the principles of economics, really. So, I think if your expectations are not right, if you don't have realistic expectations, you're going to be disappointed. As to what to invest in, I think the key is, this is like food, right? You can't just have sweets, you can't just have, I think you need a dash of everything. What the proportion should be depends on who the person's constitution is, how much of an appetite he has. There is no one answer, unfortunately, for anybody.
And I think what you have just said is the correct answer, that every single person should have a mix perhaps of all these things, and the ratio of that should depend. So if you are young,
on my constitution, on my hunger,
how much money I can spend, I think it depends on a lot of factors.
So if you're young, you have a long earning span ahead of you, you can take a lot of risk. Equity is perhaps, or maybe 60-70% in equity. If you're older, you can't take that much risk, then maybe 20% in equity and a lot more in the debt funds that you were talking about. That's essentially what you're saying.
It has to be a mix. Real estate, if you can afford it, I mean, it's a high ticket item, so if you can afford it, yes, it should be part of your mix.
In general, do all of you agree with that have a balance of everything? Yes.
Yeah, absolutely.
Of course. There's no idea.
Yes, sure.
So, okay, so that's one area in which we've got a consensus that have a balance.
But only one rider there. You can balance everything, but before the end of life, or at some point of time, preferably right at the start, if you don't get into getting a house for yourself, then I mean, retirement is going to be impossible because you just can't afford a house. So I think you better start early to get into a house, even if it's a very small house. But I would get into a house.
But once you've got a house, should you ever get a second house as an investment?
Yes,
then?
you should, because you have the benefit of long-term capital gains, which if reinvested in the residential house is totally tax-free. And when you go for a second house, you are getting 30% of your tax-free in rentals. So I think, well, I said the balance is fine, but if you balance a house too late, you won't be able to afford it at the end of the day.
I would put it this way. I think the first house that you buy to stay in is not an investment. It's a consumption item. I would treat it as consumption.
Okay.
Take it when you can afford it. You made a commitment to a city. I mean, the transaction costs on real estate are horrible. So if you're just going to have 2 years or 3 years and then going to move on, it doesn't make sense. You made a commitment to the city. You can afford it. Buy what you can afford. I think people frequently, because of the availability of easy loans, take on more than what they can chew. So buy what you can afford.
And the whole world really collapsed thanks to that in 2007.
And it is not an investment. The first house isn't an investment. The second one is.
Okay. So therefore, can I just say that the percentages now may be something which is interesting, and I'll try and get each one of your takes on what you think the relative percentages should be. What would your percentage be? Of 100 rupees or 100% of what somebody has, how much should be in what?
I would say 60 to 70 rupees should go into real estate, and that can be broken up into residential real estate and buying out leased out assets, even if they are smaller size. So you're getting fixed income coming, which is normally in line with what you would get on a corporate deposit or in bonds. And the remaining should be equally split between probably 10% on gold, 10% on equities, and 10% on mutual funds. So you can ride the beta with somebody else managing your money.
Okay.
Depends on the person and what his risk appetite is, whether he wants. There cannot be one answer for all.
Yeah.
Different people have, depending on, as I said, depending on the risk appetite, should have a different percentage. If
So the average 20 for somebody 30 to 30 years or thereabouts.
I would say that in the last 30 years or the last 33 years, the Sensex was started in the year 1980. In the last 33 years, it has given a return of around 16% per annum. Right? That's the kind of return that we are talking over last 33 years. Take last 15 years, take last 10 years, you will get similar with this one. So according to me, equity is the asset class to beat inflation. I would always take real estate for the house that I am staying in, and I don't look at real estate purely as an investment unless I can put into those ticket sizes. But a 25-year, 30-year-old guy, he should ride it with inflation, equity.
So 60-70% in equity.
That's what I would say.
What would you do?
I would put in very, very orthodox public provident fund and new pension scheme, tier 2, account 2, because I don't have great trust in equity nor having patience to analyze, because I have many other things to do in life.
Okay, so but your lack of, so public provident fund is not a bad idea, but you can only put a certain amount of money in. Can I throw another equity, another asset class in here right now, which frankly, if you ask me, you were saying a short while back that it's very difficult to find something that is both high return and low risk.
Not difficult, impossible.
Okay, you might just be having something which is available right now, which is in that category. Like you have these tax-free bonds right now, 8.5% tax-free, which is 12% return, and zero risk with they've got sovereign bonds. So what's wrong with those?
Well, first they're not sovereign bonds. I mean, they are from public sector units, they're not sovereign bonds.
The government backed when they're AAA.
I think it's implicit. AAA is the big thing. I think otherwise it's implicit. And please remember, Vikram, you're concentrating on people who earn more than 10 lakhs. it's 12% for people who have taxable income of more than 10 lakhs. Now, not everybody who's watching this show has more than 10 lakhs of
No, but
income.
it's still taxable, even if you're paying 10% tax.
So if you pay 10% tax, your return is 9%. That's it. So I mean,
For somebody who's in 33% bracket, it's a great investment.
it is a good investment. Definitely, it's a good investment. So again, I think the point to yours is even for the same person, depending on what he is eating the food for, if he is preparing for a race, which means something long term for his retirement, he might have more of equity. If he is preparing for, say, his son's education, that might happen in 5 years' time, he has to have more debt. He can't. So I think even for the same person, I think depending on what he is preparing, the answers will be different.
Okay. So let me come to you, Chirag. What percentage do you think people should have in gold? I mean, I'm surely you're not saying that it should be more than 20, 25, 30%. What would you recommend?
For gold, it's just part of the overall portfolio that you build. It should be somewhere between 10 and 20% depending on your risk appetite and your cash flows. And as far as real estate that we are talking about, given the ticket sizes of real estate that I've gone into, it's become a goal rather than an investment. So you need to save, build for that goal, and when you reach a certain particular stage, then you can invest in real estate. Until then, you need to have a mix of equity, gold, and debt in some or the other proportion, depending on what kind of risk you want to take and when your goals are there, like after 5 years, after 10 years, and depending on that, you need to have.
So when you're saying gold, you mean only gold or gold and silver? Because some people say that silver may well outperform.
No, I think it should be only gold, because gold is a store of value and a good portfolio diversification tool, which is nowhere there in India given the denomination in which you can buy into. Whereas silver is concerned, it's after getting de-linked as a monetary asset, it's become an industrial commodity. So most of the use of silver may be around 70-75%.
The stock of silver is diminishing faster than the stock of gold is.
Yeah, but after all, it's a industrial commodity. Let me give an example. In 2008, when there was a crisis, gold was only thing standing still. Silver was down along, because when silver will do well, when economic activity will do well, because it's more of its use comes from the economic activity. So only then silver is going to do well, and that exposure you're getting from other asset classes like equities. So you need not have same exposure within your portfolio.
Okay, fair enough. So the point that he made, so yes, you're saying somebody should go out and first thing they should do is to buy a house. Now he made a very valid point that most people can't afford to buy a house, and they might have to buy equity and other instruments until they can actually save up enough money to buy that first house.
Yeah, but unless you don't start making an effort today, you're not going to be able to buy it tomorrow. So my view is very simple, that you have to target when you are younger, maybe 60 to 70% of your wealth at that initial stages in life in real estate, if you want to get into a house, whatever type of house that you're looking for. But you may upgrade your house, so it's not necessarily that your first house is going to be your last house. It certainly doesn't happen even in India now. It used to, one of those good old days, but not anymore. A lot of people upgrade their houses, they are moving on. Yes, there is an extra cost of exit and entry, which is much higher than other thing, but fortunately you don't have a problem in terms of capital gains, because that is totally tax-free now if you want to upgrade to a newer house. So I would say anything from 30 to 70% depending on the size of house, place, etc.
For most people, actually, the first house is not an asset, it's a liability, because it's so much more on their net worth. It is actually borrowed money to be able to afford it. So,
but you have to understand that the growth which you're talking about, 16% in terms of the thing, we've seen that kind of higher growth than that also in the last 30 years. So if you really look at what is the growth in real estate prices which have taken place, it's 20 to 25% compounded annual growth for the last 20-25 years if you look at a long period of time. So I don't see that also diminishing now. Somehow or the other, the land prices, especially with the land acquisition bill, you're going to find land prices grow even faster than what it used to.
But can I now just say, so I want to now get into each of these, and before I come to equity, I want to spend some time on equity. Let's just finish with real estate first. The point which you're making is something which you've been correct all this time. So anybody who said real estate prices are going to start coming down is look foolish, because they haven't really come up. But can I just ask you, when you look at the prices of real estate in India compared to the per capita income of people, It's one of the highest in the world. Here in Mumbai, look at the price of a flat, compare it with the average income of a resident of Mumbai. It's off the scale. That comparison is off the scale. You don't have that anywhere else in the world. You could buy houses in parts of in America, Europe, everywhere, which will be cheaper than buying a small flat, 100 yards from where we are sitting right now. So do you think to some extent prices are so high by now in India, especially in cities like Mumbai or Delhi, that further appreciation is going to be limited?
I think all of us tend to get swayed with what we see only in the central parts of the city. And globally, the city is split between where the commercial areas are and where the residential areas are, and people tend to live in the suburbs also. And today in Mumbai, if you're willing to go into the suburbs, maybe beyond Mulund on the central belt or probably beyond Kandivali on the western belt, you still have affordable income category of crore, 50 lakhs, 60 lakhs, 70 lakh rupee apartments available. The real estate margins are already under squeeze. Mr. Ramani spoke about the cost inflation, land prices rising, a lot of governmental changes, etc. So developers have already seen a large squeeze on the margins. Beyond this, it's fairly difficult for the prices to actually go down any further, and at some point in time they will actually start moving up, which is what we've been seeing in the last 6 to 9 months now.
Radhe, if you had to take a bet on where real estate prices are going to go, do you think it's already too high?
Very high. Particularly in Mumbai real estate, my sense is that what has happened to the commercials, where at one point of time commercial were at much higher levels than residential, and the whole lot of supplies came, and today even at the cost of actual construction with the land price included, I don't think you can find a buyer in central Mumbai. I think the same is going to be the fate with a give and take, maybe 6 months, 1 year, 2 years, but I think direction looks to be that side.
So you think real estate prices could come down?
It will crash.
Real estate prices are going to crash?
In Mumbai, central Mumbai I'm talking about.
Okay, you want to respond?
What he's saying is good for commercial, but that I think he expects that the economy is also falling. So if the economy falls, commercial properties will come down, yes, but I don't see that happening in the residential segment.
Commercial,
he said commercial.
Yeah, but commercial, see the people who are going to live in those houses of 30 crores, 40 crores, 50 crores, those guys are going to be sitting in the commercial spaces to earn those income and stay there. There are no jobs or there are no positions to find those kind of incomes. So you can see the rental incomes are coming down. The flats which are available for 2 lakhs today is available for 1.5 lakhs, and they are not getting kind of people to stay there, and their yields are come down to less than 2%. So these are the indications of kind of a eventual crash. And if the economy makes a
are you saying both commercial and residential will crash?
Commercial has already crashed. I mean, you can ask them. I mean, central
and residential?
Residential is still at a sky high.
So you think it will crash?
It has to.
It has to crash. Wow. So on that rather cheerful note, Mr. Nandani, it has to crash.
Well, I think a lot of people will be very happy who will be love to go and buy those houses, and maybe I will also buy one.
After they've crashed or before the price?
After they crashed.
Do you think that's a real chance?
My personal opinion is there's already a lot, I'm repeating myself, there's a lot of squeeze on the buyer margin. There is no new supply coming out.
Look, the squeeze in a buyer market doesn't necessarily mean that prices won't crash. It means that developers will get hurt.
Which is already happening, and developers have gotten hurt. There's a lot of changes happened in the last 3 or 4 years. But we've been talking about this flattening out of real estate prices and the crashing for maybe last 8-10 years now. There really hasn't been anything which is sort of really taken off.
Doesn't mean it's not going to happen. That doesn't mean it's not going to happen. There were people who were saying that the internet bubble is going to burst someday, and it did at some point. Okay, not that I'm saying that they're going to crash. I'm just trying to see where we're headed. What do you feel? 2 views expressed last.
Let me just put a small other rider to it. I think what Ramdev is really talking about is the top end of the buying market. If you look at, I'm talking about 97% of the market. In the residential segment, is not going to fall. If you're looking at the top 3%, 5% of the market I'd like to say that there is always a segment of the market. For instance, there's a building in Bombay where it sold for 1,20,000 rupees a foot, and the next sale took place for 1 lakh of rupees. So they said 20% fall in prices. That 1,20,000 and 1 lakh is absolutely ridiculous, and I can give you the names of the buildings, which is not important, but those kind of discrepancies in terms of residential or at the extreme end of the market, yes. But if you're talking about the countrywide situation with the inflation, land prices, cost of thing, labor, government taxes going berserk. It's
Let me
not.
ask him what you're talking about. Are you talking about only the top end, or are you talking about real estate prices across the board?
Yeah, no. We are clearly talking about central Mumbai and Mumbai Island City prices, the way it has skyrocketed. I'm talking about that. I mean, the very affordable houses of 10-15 lakhs, which is say 10-15% higher than the cost of production. I think clearly cost of production is inching up every day. So clearly,
Those you think will be better?
they will be fine. But the ones which are very speculative and where FSI prices are 50,000, 60,000, or maybe when you are talking about lakh rupees house price, I mean construction cost remains still 5-7,000, maybe at worst 10,000 rupees. Rest all is all FSI prices. Those things are definitely going to carry. It's become very speculative.
Okay, let me get you in. What do you think?
We are believers of cycles. I believe last 10 years, real estate has given fantastic returns over the last 10 years. It is not necessary what has happened in the last 10 years will happen in future. Last 1 year we have been going wrong. We are waiting for real estate, residential especially, across India. We have real estate business also, where we invest with the builders at various places. And we are very cautious on that part of the business before investing. And we are doing it very carefully right now because we believe it will get corrected over a period of time. If not price
You use the
correction,
word crash, you use the word correction, but both of you seem to feel that
if not price correction also in some parts, there will be time correction whereby returns you won't get. If after 5 years the prices remain where they are, then also it is a correction according to.
Okay, so before I go to the audience and get their sense of what they're really making of, let's just come to equities, which is the big thing. Whether it's mutual funds or whether it's directly in stocks, what would be your take right now on where the value is? Are there sectors in the stock market that are really attractive that people should be looking at? Or should people, especially small retail investors, just stay away from direct stocks and only buy mutual funds?
See, we are very clear. What is happening in India is that wherever foreigners buy a particular stock, those stocks are very expensive. Consumption in India is very expensive, right? Those kind of stocks are very expensive. So if you remove 15 stocks from this country, equity in this country is available very cheap. Very quality companies are available at a PE ratio of around 5 to 6 and with a very good dividend yield. So Indians like to buy and sell. Right? Whenever there is a sale going on, we like to go and buy. So today equities are available in sale. So why don't we buy equities at that point of time? So if you have got expertise to directly buy equities, you can go and take the cheap stocks in the market. If you don't have that expertise on your own, on a very reasonable cost, mutual fund has become a very transparent, good product for the final customer, and it is a very transparent product. So I believe when the fear is maximum, that is the time to invest in equity.
Okay, Ramdev, great quality stocks available at very cheap prices right now, so you're getting them at a sale, pick it up at a sale. That's what Nimesh's view is.
What has happened is that what I've seen in last 25 years, when we started our career, it was more a stock market where you go and pick stocks, you look at the businesses, you buy pieces of businesses, you're buying a business, you try to see whether this business is going to make more money, are you buying at a reasonable price. Today it has become index market. Out of 1,50,000 crores turnover every day, almost 1,35,000 crores is all index based, options, futures, whole lot of things are there, but they're all talk of index. So stock investing focus is reduced considerably, but real money is going to be made only by buying stocks. So either you buy direct stocks or you go through the mutual funds. The guys who don't have skills to pick stocks, obviously the best way is to go to the well-recognized mutual fund and pay for the professional fees, which is about a percentage and half, which is very, very reasonable, I would say.
Okay, so let me get all of your views on buying stocks.
So I personally think that stocks is a great idea. Okay, the right time to buy stocks is today, the right time to buy stocks was yesterday, and the right time to buy stocks is tomorrow. I think for a lay consumer, he should not try to time it. This whole business about that it is very cheap now, I think nobody knows cheap, nobody knows how
systematic investment planning.
I think for most people who can't figure out whether the timing is right, or the only issue with systematic investment planning is it's boring. Okay, there's no
managing your money sometimes should be boring.
It should be boring.
It's far better to be boring than to be really poor and starving when you're retired.
And the boring people are the successful investors. I mean, people who have done systematic investments in the past, you look about what their returns have been. Okay, and there is no earthly reason. Okay, you can put a part of your money on timing based investments, which can be anything, which could be equity, which could be debt. Put a small portion. The rest of the money should be invested systematically, disciplined manner, decide it in advance and just let it go. I think that is the right way to invest for most people.
Okay. Systematic and do you believe in stocks and equity?
Yeah, I think some part of your investment portfolio should be in stocks. How you do it, whether you have the ability to choose the right stock or you depend on somebody else to do it, is obviously a question which differs from individual to individual. But with the amount of volatility and the external factors affecting the stocks, what percentage of your portfolio can really be there to do wealth creation is always open to debate and question.
Okay. Even this boring systematic investment planning route is not something that you would recommend.
I won't. For example, person belonging to a salary class of mine who earns fixed sum from Government of India, I can't afford to. So how can I advise others?
That is what national pension system is. National pension system, 50% of it is going into equity systematically.
See,
why is it any different from investing it in a mutual fund?
I guess we have to give right information here. NPS, if you see the architecture, it's sensitive to age. For about 35 person who enrolls, according to NPS, your risk appetite is less. A large chunk would go into riskless assets.
Okay.
So that's a different scheme.
So it's age dependent. Okay, I am going to take a break. I want to get the audience in and get their sense of what they think people should be investing in. That's when we come back after this break. Welcome back to the big fight. So real estate, stocks, gold, other instruments. We've got the voices from the experts. Let's just see how much has been absorbed by the audience out here. So what are you guys planning to invest in? Equity, raise your hands. Okay, real estate. Okay, let me just get, who's got the mic? Let me just get views on what you guys think is the best investment. Who wants to say something? Okay, down here, taking out the mic.
Isn't the gold ETFs would be a better investment, because then you can have you can gain two advantages from that. First is liquidity, which you don't get from gold, and then you can have the advantages of investing in gold as well. So
And third, you don't pay wealth tax. How about that? That's the third.
So basically serves two purposes.
Okay, let me get some more views from the audience. Gentlemen here.
In my view, gold is the worst investment which you can ever make. The problem with the gold is that if you put 1 kg of gold for eternity, it will remain as 1 kg. It will not, generate more income out of it, unless you have some schemes where you are able to lend the gold to the jewelers and earn some interest out of it. Otherwise, gold remains as it is.
But the value could go up, even if the...
Yeah, now I'll come to that. Why the value could go up? Because you feel that there will be enough fearfuls in the future who will come and buy the gold from you at a price which you have bought. Suppose if you have bought at 30,000, you will feel that in future you will find enough people who are willing to pay more than 30,000 for the same 1 kg of gold.
Okay, if everyone thought like you, then the finance minister would not have a problem with the current account deficit. One voice here, then I want to get one voice from the back. Oh, now there are too many hands. Yes, that one gentleman back there, then I'm going to have to leave it there.
You've spoken in detail about equity and gold and real estate, but would you suggest any other form of investment for someone, let's say around medium risk, for someone to invest in beyond these three main classes?
Okay, last comment. I'm afraid we are flat out of time. Yeah, gentlemen.
We've seen what the property bubble did to US economy. So with many experts believing that it's around the corner in India, do you still want the investor who already find it difficult to invest in real estate to bring all their money, leave aside equity and gold and put it in real estate?
Okay, I keep saying it's a last comment. Let's get one lady in at least.
I'm an MBA student and I'll probably start earning next year. So now given that my retirement is too far away and I have no kid to take care of immediately, and given the market situation, I would like to take a very informed decision. Now what kind of investment suits me at this junction when I really have very low risk and a lot of time?
You just heard them giving you all the expert gyan. There could be no better gyan than you've got. Okay, that gentleman, and then that's it.
The economic downfall that we are talking about and the current election that we have next year, wouldn't I play safe till the next year and wouldn't indulge in any investment till that time where I exactly know what the scenario is going to be?
Okay, do nothing for a while, sit on the cash, until we know what's going to happen and what's happening in the election and who's winning. So let me get final thoughts from all of you. Maybe in 10 seconds if you could sum up what you feel the immediate strategy should be.
See, I think elections or a forex crisis or economic, this is going to happen now, is going to happen next year. So I stick to a path. Be boring, and I think you will make money.
Be boring and make money.
So I think long-term wealth creation, choose your investment class and keep putting money into it. That's the only way to create long-term income for yourself.
Okay, India has lots of challenges today, but returns on investments are made on the equity side only when you invest when there are challenges. So you should invest it today, so that over a period of next 3 years you can make money.
Okay.
See that what you have at present in your hand won't be lost. So put in FD or bank or public provident fund. That's what I would say.
Okay.
It has to be a mix of assets. India is a growth story. We will continue to grow at 6.5% plus an inflation rate of about 7%. So nominally we will continue to grow at 13.5% nominally. So have a mix of assets. Equity is the main asset class that you need to be in. Add by gold so that you diversify your portfolio adequately, and add some debt so that any emergency you will not withdraw from the asset classes that are going to grow and help you diversify. You can reduce your debt investment at that point of time, use it to emergency and build it that again. So it has to be a mix of asset class, a multi-asset portfolio you need to build.
Okay.
That question on whether I would keep cash, just be careful because the value of your cash is just going to disappear. So I wouldn't keep cash if I was in your place. I would certainly invest it into something else. Somebody talked about the US markets in terms of it. We had something called subprime in the US. We don't have that in India, unfortunately. And if you look at social security in India, it doesn't exist in the true sense of the term. So if you don't buy a house quickly enough, you're going to be in difficulty. And second, yes, there are cycles even in real estate, but if you look at the long-term trajectory, it's 16% plus compounded annual growth for the last 30 years. So you have to take a decision and buy a house soon.
Okay. Final thoughts from you, Ramdev.
Yeah, so once you have decided your asset allocation, I mean, if at all it is not going to be 100% equity, in that case, I would say whatever is your, don't bother about headlines, they're always there. Media is meant for headlines. They'll keep creating everything.
I have blamed everything on the media.
Yeah. So I think buy right and sit tight.
Buy right and sit tight. In other words, you're saying what he's saying, right? Follow the boring route, keep putting money inside and make money that way.
Yeah.
All right, so you've got it from all the experts, and this is the path that you should be following. But I can tell you one thing, the one overall target that you should set yourself, start saving early enough. Keep on saving long enough and the power of compounding will take it up. But that is one thing which I guess everyone has a consensus on.
Yeah.
Don't blow up all your money when you're young.
Save and invest. Recognize your biggest enemy is inflation.
Recognize that your biggest enemy is inflation. All right, so there you have it. Lots of sound advice of what you should do with your money. If it all works well, and you remember you did hear it here on The Big Five, so keep that in mind. That's it this week on The Big Five. We'll be back again next week, same time, different place.